Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 24th April 2026, and joining Lee to pose some questions on the financial market themes for the week ahead is Henry Cook, Senior Economist. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Henry. Thanks again for joining today's podcast. How are you doing?
Yeah, not bad. It's been a busy week, hasn't it? What have you been watching?
Yeah, like I've seen the FX market, we have seen the dollar staging a modest rebound over the past week. That's helped to push euro dollar back below the 117 level, and dollar yen has once again risen back up towards that 160 level. To us this week, the dollar has benefited from the lack of progress over reaching a lasting peace deal between the US and Iran. And while this carries on, the Strait of Hormuz is still effectively closed. And as we continue to highlight, so the longer that the strait remains closed, the higher the risk of a more disruptive outcome for the global economy, which could eventually create a more supportive backdrop for the dollar going forward. At the same time, we've also seen over the past week more evidence of the negative impact of the energy price shock on the Eurozone economy. The release of the latest PMI surveys from April revealed a more kind of stagflationary backdrop, and that did help to put some further downward pressure on the euro. It'd be interesting to hear your thoughts, Henry. How do you think this kind of changing backdrop in Europe is shaping the ECB's thinking ahead of the upcoming policy meeting?
Yeah, I think ECB officials have definitely dialed back the sense of urgency. We don't expect any policy change at the upcoming meeting. I think in terms of messaging, the sort of core guidance is likely to remain unchanged. I think they're going to say they will take a meeting by meeting approach, data dependent. But there could still be a bit of a hawkish bias. I think they're likely to leave the door open to rate hikes in the future. I think there will be an emphasis on things like vigilance and agility. But certainly for now, they can afford to wait and get a bit more data, I think. The ceasefire buys them a bit of time. European gas prices are relatively contained. There's various national fiscal support measures as well, which might kind of limit fuel prices, or at least the increases in fuel prices. But yeah, I mean, Eurozone headline inflation is at 2.6%. We get some more data next week. I think it could rise to around 3% in April. So this sort of wait and see approach will become less tenable, I think. And we are likely to see further waves of inflationary pressures in the Eurozone, regardless of what happens in the Middle East. And I think it will be hard for the ECB to look past all of that. Lots of the things which are going to be affected, like fuel prices already, but also food prices to come. That's all quite relevant for household inflation expectations. At some point, it has to be a judgment call for the ECB. I think they can't wait that long to see how much pass-through there is to actual wage growth. And I think they will err on the side of caution here. I kind of continue to expect 50 basis points of ECB tightening this year. And I kind of think once the threshold has been reached for the initial hike, I think the rhetoric could change back again, and we could see a bit more urgency from officials. They could communicate that they're quite keen to keep a lid on things and send a clear message. So we still see scope for back-to-back ECB hikes over the summer. That's the sort of baseline assumption from our side at the moment.
Great, thanks, Henry. I mean, turning back to the FX market, definitely over the past week, we would say that the pound has held up better than the euro. We do think this is reflecting kind of more evidence that the UK economy is growing more strongly at the start of this year. And we've also seen as well further evidence that underlying inflation pressures in the UK still remain uncomfortably high, which we think that combination of factors is leaving kind of less room for the Bank of England to look through this energy price shock. Obviously, at last month's MPC meeting, we did see an outsized kind of hawkish market reaction. UK yields jumped sharply higher after the meeting. Obviously, since then, the Bank of England has tried to kind of push back against kind of market pricing for more aggressive rate hikes. It would be interesting, Henry, to hear your own thoughts in terms of what you're expecting from the Bank of England at the upcoming policy meeting.
Yeah, I think the sort of backdrop is very similar to that for the ECB. The main difference is the starting point. UK monetary policy is still in restrictive territory, and the UK also has more recent experience of higher inflation, with government policy essentially driving inflation a bit higher last year, up towards 4%. That's still fresh in people's minds. And actually, UK inflation is averaged over 5% since 2022. So it's been pretty far from the Bank of England's target. Based on our current energy assumptions, I see inflation in the UK rising slightly above 4% this time, but by the end of the year. There's already clear signs of rising expectations for both businesses and households in the data. Again, it's going to be some time until there's definitive evidence of the kind of scope for second round effects on wage growth. My view is, just like the ECB, I think the Bank of England might err on the side of caution here. No policy change expected next week, but I think it will be hard to get the tone right. As you said, the messaging in March was a bit clumsy, to put it kindly, and I think this time there will be a focus on uncertainty on the medium-term inflation outlook, but it is also plausible that at least some MPC members will vote for a hike, led by the chief economist Hugh Hill, or at least kind of signal an intention to do so later on, which could become a bit of a market focus. In terms of our baseline assumptions and expectations, we've sort of penciled in one hike from the Bank of England later this year, but I am sort of leaning towards more tightening, depending on the messaging next week and what the upcoming data looks like. As you said, the recent activity data, GDP, the PMIs, they've been quite resilient. The economy is carrying a bit more momentum than we would have expected. And, despite some signs of labour market slack, I think the MPC will kind of lean on the side of caution here and want to stamp out any risk of inflation persistence.
Yeah, I mean, looking back at FX performance since the conflict in the Middle East started back in late February, it's pretty clear that the pound has kind of outperformed over that period. We think that's, like I say, reflecting the bigger adjustment to the upside that we've seen in UK yields compared to in other major economies, and the resilience so far for the UK economy's performance. Like, obviously, we think going forward that resilience may start to slip as we move towards the summer, but at least in the near term, that is offering the pound more support. In contrast, though, if we look at currencies which have kind of underperformed during the energy price shock so far, the yen kind of stands out as the kind of clear underperformer. I mean, to us, this is no major surprise. It's very similar to the negative price action that we saw for the yen following the last energy price shock when Russia invaded Ukraine back in 2022. Obviously, this negative terms of trade shock for Japan's economy from higher energy prices is driving the yen weaker. And then on top of that as well, it definitely looks like the BoJ is going to remain cautious over raising rates further in response to this period of heightened uncertainty. Certainly the latest media reports that we've seen over the past week have suggested that the BoJ is likely to leave rates on hold at the upcoming policy meeting. So we've decided to push back our own forecast for the timing of the next rate hike from April to June. We still think, though, that the BoJ will deliver a hawkish hold at the upcoming meeting. We think that they will still signal that they are moving closer to raising rates, which would leave open the door for a rate hike as soon as the following meeting in June. And we think that that hawkish guidance would be supported as well by a big upward revision to the inflation forecasts from BoJ members as well at the upcoming meeting. However, I think for the yen, even if we do see hawkish guidance from the BoJ, I don't think that's going to be sufficient to prevent the yen from weakening further. That weaker yen will continue to put pressure on Japan to provide more support for the yen, potentially by backing up verbal intervention with action. Obviously, the need for intervention would increase if we were to see dollar yen break back above the 160 level in the week ahead. That's it for today's podcast. Thanks again, Henry, for joining us, and to all of our listeners. We'll be back again next week, and have a good week ahead, everyone.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.